My name is Jez Howson, and I'm a director in Azets employment tax team. I want to set out today my thoughts from the employment tax perspective on yesterday's budget announcements. Now that the dust has settled on the Chancellor's budget statement, I've been reflecting on what it means for employers and employees, which I want to share with you now. Unusually, compared to recent budgets, or should I say notorious mini budgets, there was very little announced in respect of employment tax. But what was clear from the Chancellor's statement is the objective of the government to address the labour issues in the UK economy, which will, he hopes, ultimately drive up growth in the economy and UK productivity. To achieve his goal, the Chancellor has announced two key targeted areas which he thinks will help to tempt early retirees back to the workplace, and an announcement targeted at parents who are on effectively enforced career breaks due to current childcare costs. The first one is to introduce, he's introducing is something called Returnerships for over 50s. According to the Treasury publications, the number of inactive in the workplace 50 to 64-year-olds has increased by 320,000 since the pandemic. Returnerships are effectively apprenticeships, but will be targeted at upskilling people who want to return to work. It's not clear yet whether employers will be able to fund this training from their levy pots or receive co-funding from government as part of the existing apprenticeship levy scheme. It's also not clear if the training providers will have to be apprenticeship scheme accredited providers in line with current rules, which are overseen by Ofsted, and both will need to be confirmed. The second area targeted at the over 50s, announced by the Chancellor, relates to pensions. And again, he is hoping the changes will bring back early retirees to the workplace. So what are these changes? Well, from the 6th of April 2023, the annual allowance, which is currently £40,000, will increase to £60,000, which is effectively a 50% uplift. The second change is to the lifetime allowance, and rather than being increased as rumoured in the run-up to the budget, it's going to be abolished from April 2023. These announcements for pensions are still effectively headline ones, and care should be taken until the full details are published in the future finance bill. So individuals should certainly seek advice from their financial planners before acting on these changes. From an employment tax perspective, what do these changes mean? Well, it certainly looks like an opportunity for employees to exchange more earnings chargeable to tax and national insurance, and also for employers, when employees do this, to save national insurance. A good example of this might be some planning where a high-earning employee is entitled to a bonus. Under the current lifetime allowance, it may not be advantageous or absolutely not make sense to give up all or part of a bonus into their pension pot because they've reached that lifetime allowance. But the abolition of the allowance and the increase to the annual allowance may present an opportunity to give up the bonus into the pension, which for employers would save 13.8% on the amount given up by the employee. So a definite opportunity there. It's similar if you look at settlement agreements. So where someone is being paid a lump sum on termination of their employment, and assuming all the tax and national insurance elements of the settlement, such as payments in lieu of notice, accrued holiday, that sort of thing, have been correctly treated for tax and national insurance, a further ex gratia payment can be made. And as many of you will know, a payment up to £30,000 can be paid gross. However, if the ex gratia exceeds that £30,000, tax will be chargeable on it. One of the options you can consider is giving up part of that taxable amount into a pension. But of course, with the lifetime allowance and annual allowances, that you may have been restricted on doing so. So there is an opportunity with the abolition of the lifetime allowance to actually potentially contribute more into your scheme in such circumstances. Okay, so a third element to the goal for getting workers back into the workplace is the provision by the government of further childcare support. So what they're basically setting out is an intention for 9-month-old children right the way through to 4 years of age to be provided with some further childcare. So very briefly, the details of that provision are for working parents of 2-year-olds. They're going to be able to access 15 hours of free care from April 24. And from September 2024, the 15 hours will be extended to all children from 9 months up. Finally, from September 2025, the government will reach their final goal of providing parents with access to 30 hours free childcare for all children up to the age of 5. So significant change there. And it's a change that should provide employers with an opportunity to access a wealth of talented people and resources who left the workplace due to those childcare costs. However, those employers who are in the childcare sector will also need to start planning its resourcing in preparation, as there will be a significant increase in demand for nursery places. That might be slightly mitigated by the extension of the number to carers to children ratio, which is moving from 4 to 1 to 5 to 1. There's further help for nurseries that will, to help with the increased demand, and the funding for further free hours will be increased by £204 million from September 23, rising to £288 million in 2024. Further, to assist in the supply of childminders for parents, incentive payments will be made to new childminders of £600 for those who register with Ofsted and £1,200 for those who join through an agency. So employers should be considering how they could benefit from the increased talent that will potentially become available and start to plan now based on the staged introduction dates. Finally, tucked away in the budget publications is some additional leeway to short-term business visitor arrangements where the rules will be simplified. These arrangements allow for visiting employees to remain in their host country's tax system when visiting the UK for work for a short time. The rules are expected to include expanding the range of activities that can be carried out whilst here in the UK. And again, we're yet to see the real details on this announcement, but the suggestion is that additional rules are going to be introduced from the autumn of this year. So, at the very latest, we should have that detail by the summer. So this brings our budget commentary from the employment tax perspective to a close, but it's clear that detail will need to be seen before making any firm plans around training up early retirees, or indeed reacting from a planning perspective to the pension announcements. And I should reiterate that as employers, you should suggest to your employees thinking about the pension changes to seek financial advice from a qualified advisor before making any firm decisions. If you would like to discuss any of the areas covered in this video, do feel free to contact me or indeed any member of your local Azets team. Thank you.